Modern global trade operates at a scale that is difficult to visualize. Every day, single corporations manage billions of dollars in assets, coordinating supply chains that span dozens of sovereign borders simultaneously. Standard definitions categorize a multinational corporation by its physical footprint, simply a business that maintains offices or sells products in multiple countries. In practice, global dominance is a product of structural architecture and financial engineering. This creates a unique operational advantage, the ability to control global supply chains more profitably than any network of independent domestic firms could achieve. To understand how these entities actually function, we have to look past the physical products they move and examine their hidden architecture of control. International expansion requires a corporation to move capital across a sovereign border. One method is portfolio investment. This is financial speculation, buying shares in a foreign company to capture a return without seeking a seat at the management table. As this comparative table illustrates, the defining characteristic of foreign direct investment, or FDI, is management control. FDI is the actual bedrock of a multinational corporation. Unlike a liquid stock trade, FDI involves locking capital into physical, illiquid assets, things like foreign manufacturing plants or specialized R&D subsidiaries. This commitment is both capital-intensive and risky. It exposes the parent company directly to local political shifts and economic volatility in the host country. If FDI requires this much upfront capital and carries this much risk, how does an apex corporation manage to control massive global assets without jeopardizing its own financial survival? A multinational corporation cannot afford to fund its entire global footprint out of pocket. It must use structural leverage to multiply the reach of its capital. This is the pyramidal holding structure. It is a formalized strategy for controlling vast corporate peripheries with limited central capital. The math of the pyramid relies on a simple rule of governance. Total operational control of a subsidiary only requires a 51% equity stake. Consider a scenario with 9 separate operating companies at the base of the structure. If each holds $100 million in assets, the total base value is $900 million. These base companies are grouped under a middle layer of Tier 2 subsidiaries. This separates risk and creates a buffer between the operating units and the parent company. By applying the majority stake rule at this level, the Tier 2 companies only need to purchase $459 million in equity to control the entire $900 million asset pool. The final master company then acquires 51% stakes in those 3 intermediate subsidiaries. Through this tiered ownership, the apex corporation controls a massive global periphery, using only a fraction of the total required capital. This structure can be repeated across any number of layers, stretching a corporation's capital thinner as the network expands. In this model, minority shareholders fund the remaining 49% at every level, effectively subsidizing the expansion of the apex's network. The multinational does not own its global assets outright. It operates an empire on margin through a chain of fractional ownership. While the pyramid provides control, managing these vast, decentralized networks introduces significant administrative friction. As these conglomerates grow, they often encounter diseconomies of scale, where the cost of internal coordination begins to outweigh the benefits of size. Analysis of corporate performance, including studies featured in Businessweek, shows that the return on equity for these giants often lags behind smaller competitors. Their dominance is not sustained by operational leanness, but by regulatory and tax advantages. These advantages are captured through jurisdictional arbitrage, specifically a mechanism known as transfer pricing. Transfer pricing is the internal pricing mechanism used for goods, services, or intellectual property traded between subsidiaries of the exact same parent company. Take the example of ASEA Brown Boveri, operating in 2 different jurisdictions, Switzerland with a 25% tax rate and India with a 35% rate. A vital component is manufactured in Switzerland and shipped to the subsidiary in India for final assembly. If the part is sold at its actual production cost, the bulk of the final retail profit is realized in India. This subjects that profit to the higher 35% tax rate. To counter this, the Swiss parent can artificially inflate the internal transfer price of that component by 20% before selling it to its own Indian subsidiary. The Indian subsidiary's operational costs rise, which shrinks its taxable profit margin in the high-tax jurisdiction. That extra money paid by the Indian unit registers as increased revenue in Switzerland, where it is taxed at the lower 25% rate. Without changing the physical product or the price paid by the end consumer, the corporation has successfully shifted its profit pool across a border. In this scenario, the corporation acts as its own global market, setting its own prices to defeat local taxation. Profit for a multinational is a mobile, manufactured metric, intentionally detached from the location where the physical labor or manufacturing actually occurs. The modern multinational corporation functions as an integrated, three-layered financial system. The foundation is foreign direct investment, capturing physical market share and local labor. The structure is the pyramidal holding company, multiplying the apex capital by a factor of 4-to-1 or higher. And the engine is transfer pricing, routing profits through the corporate plumbing to bypass jurisdictional tax nets. These three tools operate in unison. The pyramid buys the control, FDI builds the factory, and transfer pricing extracts the wealth. Massive size is a byproduct of this architecture, rather than the source of its power. While nation-states are bound by geography, multinationals exist as liquid networks operating over top of them. To understand global business, you must look past the physical supply chain of goods and examine the hidden mathematical architecture of the holding company.